so the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. The conundrum is, okay, they've been raising rates since March 2022. Monetary policy works with a lag. Inflation peaked in July 2022, and it has been coming down ever since. That's, some months were, February was a little hot January was hot compared to December. But the trend has been down. So they're raising rates and inflation is coming down. So that's good. But here's what they don't know. Was inflation coming down because they were raising rates? Or had they already hit the terminal rate and they just didn't know it? Because Wall Street was like, no, you've hit the terminal rate. Stop, please stop. You got this under control. The Fed doesn't believe that. One of the greatest blunders in monetary policy was Paul Volcker in 1980, who had started raising rates in 1979, and inflation was coming down. But then in 1980, we had a very sharp recession that had nothing to do with monetary policy. It wasn't caused by Paul Volcker. Jimmy Carter put a cap on credit card interest, and banks stopped issuing credit cards. So, well, that'll sink the economy. And then so Volcker reacted to that by lowering interest rates 7 percentage points, not 70 basis points, 7 percentage points, because we're in a recession, right? That's what Feds do. The Fed chairs do. But because it was a regulatory blunder, they fixed it and the economy came roaring back. And then inflation really took off, worse than when Volcker got in 79 and early 1980. So Volcker had to take rates to 20% to get inflation under control the second time after cutting them in 1980. And that's called the Volcker mistake or the Volcker blunder. And Volcker himself, I spoke to him, he said that was a mistake, that I should have stuck to my program, not worried about the economy and unemployment, but just got inflation under control. But when he threw in the towel prematurely, the inflation went to the moon. This is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, etc., and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. Jay Powell doesn't want to be that guy. Jay Powell knows that episode as well as I do. And he doesn't want to be the guy who throws in the towel early and then inflation just goes to the moon, and then then he has to take interest rates to, 15% or something ridiculous. So Wall Street's saying, you're already there, mission accomplished. Powell's saying, not so fast. They told Volcker that, and he cut rates, and it was an enormous mistake. So Powell's not going to be that guy. So what is the terminal rate? 2 weeks ago, it was 3 weeks ago, it was at 5.25. Today, I would say 5.5, because we had a lot of hot data, unemployment down, job creation up, retail sales up, not to the moon, but these are the opposite of what Powell is looking for. So he's had no confirmation that inflation is coming down on its own. He's had a lot of data that says inflation may be getting ready to take off again. So you got to say the terminal rate went from 5.25 to 5.5, maybe more. Let's see what he does in June. So that's and Powell always said, I don't care if there's a recession. I don't care if there's unemployment, because the long-term costs of inflation are going to be much greater than those short-term problems. We got to suffer through that to get a bigger problem under control. These are the three danger zones under threat of economic collapse I'm concerned about most, and I'm going to talk about each one now. Danger Zone 1, America's food supply. According to the CDC's website, a disaster can easily disrupt the food supply at any time. In the event of disaster or emergency, they advise Americans to have at least a 3-day supply of food. But have you ever asked yourself, what happens if multiple disasters hit our food supply chain simultaneously? So you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. So the problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare. It means that, you know, you may not like the price, but you have no choice. You've got to go to work, take the kids to school, deliver goods, use your truck and your job, whatever it is, you have to do it. You have to pay that higher price. But it means that $75 extra at the pump, maybe twice a week, so $150 a week. That's $150 you don't have to spend on something else. Could be concert tickets, a show, dinner, a new dress, a new suit of clothes, whatever it might be. You're not going to buy that because you've just spent that much money on the gasoline. Well, that means all those other industries suffer. Retailers have lost sales, restaurants have empty tables, concerts have empty seats, and so forth across the entire spectrum of goods and services. Well, soon enough, that results in layoffs, some business failures, price cuts, etc. And that disinflationary and deflationary trend ends up in a recession. Danger zone number 2, America's energy supply. See, even after a trucker strike, the only way the trucks can deliver our food is if they have enough gas to run on. And right now, we're in the middle of the worst energy crisis since the 1970s. And not just because of rising prices at the pump. As you may know, in the aftermath of that oil crisis, our government built something called the Strategic Petroleum Reserve, SPR. For a worst-case scenario, we all hope never comes to pass, over the last 50 years, it's grown steadily from administration to administration, having recently hit 564 million barrels of oil. And then suddenly, everything changed. And while the situation surrounding the way we get our food and energy is bad, it's this next danger zone that keeps me up at night. Danger zone number 3, America's medicine supply. Think about it. We're the world's largest economy. That means we have a bullseye on our back. I believe a coming conflict with China, it could be another trade war. You know, I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, you know, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come that hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5 on the exact numbers. We haven't seen that level of unemployment, that low, that is, since the 1960s. And the Fed is absolutely looking at that. And of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, having said that, what else is the Fed missing? Well, Wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah. So your real wage just went down, because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years. It runs around 5% annualized, give or take. Sounds like, hey, 5% raise, what do you want? Well, yeah, but your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. First of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. And again, even if you allow for legitimate reasons for a lot of them, there's a big untapped labor pool. There are a lot of people who are sitting home watching, the football playoffs and not going to the unemployment office. That's the thing. You have to go to the unemployment office online or whatever. You have to at least look at a job to be counted as unemployed. If you're not looking, you're not counted as unemployed. But you're still a person. You're still capable of working. You're just not looking, which is a very negative sign, by the way. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. That's a depression level of unemployment. The dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. Now, dollars come off a little bit, kind of starting in October, but I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There is a serious dollar shortage, and people roll their eyes. They're like, wait a second, China's dumping treasuries, Brazil's dumping treasuries, people hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is. And we can see it, but there's a reason for it. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off balance sheet. So they don't show up in, conventional ratios. You got to read the footnotes and they don't tell you that much. So, okay, what supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay. So in a credit crunch, you're going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them. That's what will drive the dollar higher. So they're desperate. They have to get dollars to prop up their own banks. If you're the People's Bank of China, you got to prop up the Chinese banking system. If you're the Swiss National Bank, you got to prop up Credit Suisse, etc. The Fed will actually give you all the treasury bills you want. All you have to do is just do a reverse repo with the Fed. You deposit your cash with the Fed, and they send you treasury bills, and it's like, can be overnight, 1 week, whatever. And at some point you unwind it. But what you usually do is just roll it over. So a phone call to the Fed will get you all the treasury bills you want. So why doesn't that solve the problem? The answer is the Fed bills cannot be rehypothecated. They can't be used the way the dealers want. They can't send them to Deutsche Bank. But if I buy the bills at auction, I can. And so there's a liquidity preference for buying treasury bills at auction because I can pledge them to somebody else, and that's what they do. But if I do the reverse repo, I got to hang on to them because the Fed won't let me rehypothecate. And so that's why the yield to maturity at auction is lower than what the Fed will give you for basically for free. But it's another one of these weird, quirky little inversions, but it tells you something. It tells you exactly what I said, which is there's a dollar shortage, and that will get worse as we go into a recession and credit losses pile up and banks get stressed and balance sheets get reduced and dealers say, it's treasury bills, give me a 4-week bill. That's going to drive the dollar higher against basically the euro. I write books and I also write several financial newsletters. So I'm thinking about topics all the time. And there's always one, usually I say, well, all right, this war in Ukraine is a really big deal. Got to cover that. Or financial implosion in China, really big deal. Got to cover that. Or what's going on in the U.S. and other topics. I could give you a long list, maybe the end of the dollar's role as a global reserve currency, et cetera. The difficulty now, they're all going on at once. Any one of those topics would, fill a newsletter or be a big topic, a heavy lift, but they're all going on at once. And number two, they're not unrelated. There are all kinds of correlations. The breakdown and collapse of the global supply chain, which preceded COVID. A lot of people say, well, COVID came along. Of course, it messed up the supply chain. In my new book, Sold Out, I've got very, very good documentation that shows the supply chain was breaking down before COVID. Now, of course, COVID made it worse. Yes. And the war in Ukraine made it worse yet. Yes. But this really started with Trump's trade war in 2018. So, that, like I said, there's a thread that runs through all these things. So, when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, they're all a big deal. The war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. It's interesting because I do have, kind of an international following, but there are certain pockets. I mean, there are certain countries where, there's interest in what I do, or my books are published in that language, et cetera. So I have a good German following, and of course the Germans want to know what's going on with energy, Japanese following. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming. And there's data. I never make statements like that without supporting it. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, and there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions. And they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's the greatest bubble of all time, real estate, stocks, and other asset classes. So, I do, that is my view, but it's shared by a number of other analysts. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82%. From top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happens. So we're down. Nasdaq's down, bounced back a little bit, down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect. The soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. That's not priced into markets. The markets are pricing in a soft landing. They're not pricing in a really hard landing. So you have what's called cost push inflation. That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, kind of do without. We are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation, and you see that in inflationary expectations and inverted yield curves. And I'll come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping, and people would be in a frenzy to buy stuff. They're not. And the yield curves are not sloping, or upward sloping. They're inverted. They're going down. That tells you that, and we also see it's inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us is that, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, I'm sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price, and consumers are really bracing for that. So the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing, but that's not priced into markets. The markets are kind of pricing in a squishy landing or a soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get. We may have a very bad recession, possibly worse than 2008. So tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay, yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets where you ended up losing everything, but for a couple of days or weeks even, it's hey, the bottom's in, and you buy stocks, etc. So you have to watch out for that. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of that. Some of the buy the dips people are still around, so count on them to buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the NASDAQ dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. I mean, that's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are two huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates, we're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian Finance Ministry and 19 banks and, a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked. But it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later. But that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference. There are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 19, 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, what's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain, we all remember headline, supply chain is broken down, the shelves are bare. So all true. That was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, or tripled the orders. They said, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff, retail sales drop off a cliff, the warehouses go from being empty to being full to the rafters, and now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness, the Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve and their focus on the unemployment rate, which is not a good measure of what's going on in the labor force. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. Supply chain is not part of the economy. Supply chain is the economy. In other words, if you want to understand the economy, you're really talking about the supply chain at every aspect. Something as simple as a loaf of bread. You buy a loaf of bread at the grocery store. Like, okay, well, I guess it came from a baker, and I guess they took it from the bakery to the store by truck. So there's a supply chain. Well, that's about as simple a version of the supply chain as you can imagine. You have to just start going from there. It's like, well, did the bread come in a plastic wrap wrapper or a paper wrapper. Well, that wrapper came from somebody. Where'd the truck come from? Well, obviously a truck manufacturer. Where'd the driver come from? Somebody had to make a career choice and be trained. And what about the diesel fuel in the truck? That came from a refinery, and that came from oil exploration. Then you get back to the baker, and it's like, oh, well, I guess he had an oven or she had an oven. Where did that come from? And then you find out that the ovens are, industrial ovens have parts from 25 different countries and so forth. Well, without belaboring that point, you get back to the farmer and the wheat and the fertilizer and everything else, and really what's called the extended supply chain. And you're like, wait a second, that's a huge number of countries, a huge number of imports, and a big part of the economy, which it is. And then every link in that supply chain I described has its own supply chain behind it to get to source materials and intermediate manufacturing and so forth. And then that's for a loaf of bread. Well, what about your car, your furniture, your clothes, and on and on and on. Once you start thinking about what supply chains are, you realize it's just the cardiopulmonary system of the entire global economy. So, the supply chain book shines a light on the entire global economic process. And I have whole chapters on that talk about China, the war in Ukraine, and climate change. And you say, well, the interesting topics, but what do China, Russia, and climate change have to do with the supply chain? Well, the answer is they are, kind of global macro earthquakes. Russia's invasion of Ukraine led to sanctions against Russia that affect everything, imports, exports, strategic materials, semiconductors, fertilizer, oil, natural gas, etc. Again, you're saying, well, okay, Boeing makes aircraft. They need titanium and aluminum. Where does that come from? Turns out about 30% of it comes from Russia. So how are you going to keep the Boeing assembly line going when you're shutting down strategic metals from Russia? I can go kind of on and on there. China, everyone says, well, they've slowed down because of the zero COVID policy. And that certainly has been detrimental to their economy. Shanghai, a city of 26 million people, Beijing, a city of 22 million people, they were both locked down entirely last spring. When I say entirely, no transportation in or out, nobody on the streets. You had some essential workers, people had to get to work. You had to have a COVID test, a negative result that was not more than 2 days old. So these were extreme lockdowns and obviously very, very detrimental to the economy. Now, those have died down a little bit, and China's saying, now we're going to relax our zero COVID policy a little bit. So what's new? Why are supply chains breaking down? What's new about the supply chain that makes it different than any other period in the history of the world? And what's new were two things, and they arose around 1989. The first was you had a combination of increased computing power, algorithms, artificial intelligence, better data collections, a new model. So you suddenly had the computational telecommunications and data and mathematical tools to be a lot more sophisticated about how you handle the supply chain. But the second thing that happened at the same time was 1989, the fall of the Berlin Wall, 1991, the collapse, demise of the former Soviet Union, which gave rise to new trading partners in both in Eastern Europe, where they were no longer behind the Iron Curtain, Poland and Romania and Hungary and many other countries. And at the same time, you had the rise of China. China did have a fairly high growth period in the 1980s, but nothing like we see today. And it all came crashing down in 1989 with the Tiananmen Square massacre. And that really shut down U.S.-China relations, not fully, but there was no Western investment coming into China. The two countries were distant. Well, that ended around 1992. Deng Xiaoping did what he called the Southern Tour, where he reaffirmed China's commitment to capitalist principles. They weren't overthrowing communism, but they were embracing capitalist market ideas. There was a thaw in U.S. relations, and then it was like, no holds barred. Then that's when the U.S. investment really did pour in. So all in a short period between 1989 and 1992, you had the fall of the Berlin Wall, the fall of the Soviet Union, new republics. China kind of re-enters the game, and all this was globalization. So now all of a sudden you had the science I described, computing and artificial intelligence and applied math. and a true global market. So now the supply chains could go 9,000 miles from Chongqing to New York, or from Shanghai to Seattle, or London to Hong Kong, of course. So this was true globalization, much larger scale, much longer supply chains, and it worked. And so this was a period I call supply chain 1.0, 30-year period from 1989 to 2019. Now, why did it break down around 2019? Three things. A lot of people look at the pandemic and they go, oh yeah, COVID, that disrupted everything. That was the problem. And some people look at the war in Ukraine and the Russian sanctions and go, that was the problem. And they both made it worse. They both made it worse, no doubt about it, made the supply chain worse. But it really started in 2018 with Trump's tariffs on China. So Trump put tariffs on appliances and solar panels. Well, China didn't stand still for that. So China said, well, what can we do to strike back? Well, at the time, China was and is the world's largest importer of soybeans. They need the protein. They don't have enough. The U.S. and Brazil are the two largest exporters of soybeans. Well, China was buying all their soybeans from the United States because they were trying to reduce the trade deficit. We were buying so much stuff from them, and China said, well, what can we buy from the U.S. just to kind of balance the books a little bit? And the answer was soybeans. Well, when Trump put the tariffs on, China redirected all of their soybean orders to Brazil. They stopped buying U.S. soybeans and they bought them all from Brazil. Well, there's a lot more to that than a phone call. You got vessels and dry bulk carriers and transportation lanes and port facilities. And, if you're Brazil and you get all these orders, you got to get trucks to get the soybeans to the ports. You got to open up port facilities, et cetera. The point is, this is a major, major shift in global logistics, just to change the order book from the U.S. to Brazil. Beyond that, people involved in this, they don't want 6-month contracts. They want 5-year contracts, or at least 3-year contracts, and they got them. And so now all of a sudden, China's buying all their soybeans from Brazil, but this scrambled global supply chains. Now, what are the U.S. farmers doing? We're still growing the soybeans. We can't sell them to China. Well, it turns out the Netherlands needed them. So, okay, we'll sell them to the Netherlands and distribute them to Europe, which they did. And then this went on and on because Trump put more tariffs on to retaliate. China took more actions against the United States, canceled purchase. So, and it escalated from there. Now, again, COVID made it worse. The war in Ukraine made it worse. But it's very clear that that's where it started. So that's why I use 2019 as just, kind of an arbitrary date, but a 30-year period of supply chain 1.0. Now we're getting to supply chain 2.0, but we're not there yet. We're in this messy, in between, inefficient, muddling through period where things are broken, but they'll never be put back together the way they were, but we haven't produced or created the new model supply chain. We're just muddling through, and with a lot of disruption, a lot of empty shelves. You have to understand, it took us 30 years to build this. We blew it up in about 3 years. It's not going to come back overnight. It's going to take 5 or 10 years, or maybe longer, to rebuild in some form. I would say that the Fed's monetary policy will fail, or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear, fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And, they look into the future. Here's their forecast. They pick out a discount factor, they present value it, and say, here's where stocks should be today.
based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. There's a number of different techniques, and what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But it could go down tomorrow, and I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, etc.
Small ebook, big impact, The Wealth Tree. The only 4 ways that will make you financially free forever. Download it here for free.
But right now, all three of them are flashing green, or maybe flashing gold. The real rates are coming down. They're still high, by the way. I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all, and I follow them all. But they've all been carried out feet first on this, bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, etc. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings was tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, the DV01, dollar value of 1 basis point, is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. We're not even there yet. We're seeing we're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spiked to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired a guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need...
Countries like Switzerland, Germany, Austria, China, and various Asian nations have maintained a strong affinity for gold. In contrast to the United States, where gold investment is often overshadowed by more traditional financial instruments, these countries have a deep-rooted appreciation for the precious metal. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
They are accelerating their purchases, and I do think it's a sign of things to come. Now, when you talk about retail, so everyday investors, Americans, I love America, but I've kind of given up on Americans and gold. They just, there are people who have positions, and, your hedge funds will have paper gold, they'll do gold futures, but the everyday American has been, 40 years at this point of being miseducated on the topic of gold. So they're not very much into gold. You go around the world, you get very different results. Switzerland, Germany, Austria, they love gold. Of course, China, Asian countries, I think Australians have a much better sense than Americans do. So there are the buyers of gold. But you say, well, okay, who are the big buyers of gold? The answer is the central banks. Now, right there, that should tell you something. So these are the most powerful, most plugged in, most heavily monetary institutions in the world. And they're the ones buying gold. Now, they would have you believe that gold's not money, gold serves no purpose. It's the first ones to say, John Maynard Keynes said it was a barbarous relic, which he never said, by the way. He said something, he used the phrase barbarous relic in reference to the gold exchange standard of the 1920s, which was a hybrid gold foreign currency standard, but the foreign currency is not gold. So he said that's a barbarous relic, but he never said that about gold himself. And actually, toward the end of his life, he favored, at Bretton Woods, he favored a global currency called the backward, backed by gold. And, it's not guesswork. There are papers he published at the time. And that was rejected by the United States, which kind of ran the show, partly because not to get too down in the weeds, but our Undersecretary of the Treasury, who was our representative at Bretton Woods, was a Stalinist agent. He was a communist. This didn't come out until the 90s, after the fall of the Soviet Union, when a lot of classified information was released, KGB files, etc. But it was revealed and fully documented in a book by Ben Stile called Battle of Bretton Woods, that he was a communist agent. So what was he trying to do by insisting that, by running Keynes's idea off the road, insisting that the US dollar be the anchor? He was trying to destroy the British Empire, which he did, because he knew that there were far more claims on the Bank of England than they had gold, and that would be inherently unstable, and that would derail sterling as one of the global reserve currencies and undermine the British Empire, which it did. So that's a little bit of a backstory, but it goes to the point that Keynes was an advocate for gold at different times in his career and at the end of his career, and that when the central banks are buying, that should tell you something. Now, I've said for years, I've always pointed to Russia and China. Russia has almost quadrupled their gold reserves in the last 12 years, starting in 2009 through 2021. They've almost quadrupled, from about 600 tons to about 2,400 tons. China, the same, not quite, from about 600 tons to about just under 2,000 tons that they report. But they're non-transparent. They have a lot more gold than that stashed in something called SAFE, the State Administration on Foreign Exchange, which is a secretive Chinese sovereign wealth fund run by an ex-PIMCO guy, by the way. He knows what he's doing. And they're non-transparent. So the People's Bank of China is kind of transparent. SAFE is non-transparent.
The crux of Jim Rickards' argument lies in the behavior of central banks, the most powerful and influential monetary institutions globally. Rickards highlights that central banks, including those in Russia and China, have been steadily increasing their gold reserves over the past decade. Russia, for instance, nearly quadrupled its gold holdings from 2009 to 2021, while China, although less transparent, has also significantly boosted its gold reserves. What is particularly telling about central banks' interest in gold is that they are the custodians of monetary policy and are deeply ingrained in the global financial system. Rickards argues that their preference for gold should not be dismissed as mere nostalgia for a bygone era when gold was the primary backing for currencies. Instead, it reflects a strategic decision to safeguard their wealth and financial stability in an ever-evolving economic landscape. Jim Rickards dispels the notion that gold is an outdated relic, as some critics argue. He points out that even renowned economist John Maynard Keynes, often cited as a critic of the gold standard, had different perspectives on gold throughout his career. Keynes indeed criticized the gold exchange standard of the 1920s, but he later advocated for a global currency backed by gold.
So every 6-7 years, what you'll see is the People's Bank of China will announce, we've increased our gold reserves by 400 tons or 500 tons or whatever, as the case may be. And well, it sounded like they went out the night before and bought 600 tons. Good luck trying that. You can't do it. Well, what it means is that SAFE took some of the hidden gold that they had been acquiring slowly and in an accounting entry moved it over to the People's Bank of China, and boom, there's 500 tons overnight. But of course, they had it all along, and they still do. So they probably have more. So Russia and China are big acquirers, again, tripling and quadrupling their gold reserves. But now we're seeing it in a lot of other countries. The Philippines, Vietnam, Mexico, Iran is a major buyer, but non-transparent. Turkey has drastically increased its gold reserves. These are major countries, and they're adding. So I look at that, and there's very good data from the IMF and the World Gold Council, so you can find this information. But the one that was just like not doing anything was Japan. They had about 600 tons. But they had 600 tons for 30 years. I went back and looked at all the old data. It was like 30, never, that's boring. Who cares about Japan? 600 tons. And then just about, at this point, about 6 months ago, so late last summer, they bumped it by, I believe it was 50 tons, perhaps more. I gotta look at the exact number, but it was over 50 tons overnight. It just went from, 600 tons to 650 tons, just like that. Well, here's what you know. same thing I said about Russia. You can't buy 50 tons overnight, or you couldn't even do it in a month. I mean, the dealers would be working the order, it would be disruptive to the market. It would leave a lot of fingerprints, put it that way. But what it tells you is two things. Number one, Japan had the gold all along. They had it in some sidecar or side account or Ministry of Finance hidden account, what as the case may be. And they chose to move it over to their reserve position, which they can do. That's an accounting entry, but they had to have had the gold all along, because you can't buy that much that fast. So then that begs the question, well, why all of a sudden? Why now, after decades of holding your gold level constant, do you all of a sudden step up in a big way? A lot of possible answers to that. One, China's making noises about invading Taiwan. Well, if you're going to invade Taiwan, why not invade Japan while you're at it? It's just another chain of islands as far as the Chinese are concerned.
Rickards emphasizes that the misinterpretation of Keynes' views on gold has perpetuated the misunderstanding of the precious metal's role in the modern financial system. In doing so, he underscores that gold has historically played a vital role in global monetary systems, and its significance should not be underestimated. As central banks continue to accumulate gold reserves, the question arises, why? Jim Rickards suggests several reasons. First, gold serves as a hedge against the US dollar's potential devaluation due to inflation or loss of confidence in central bank currencies. Second, it can act as a buffer in times of economic crisis and geopolitical uncertainties. Rickards also speculates that the actions of central banks like Japan, which recently increased its gold reserves significantly, could be driven by concerns over the reliability of the United States as a geopolitical ally. The aftermath of the U.S. withdrawal from Afghanistan has left many nations questioning their dependence on U.S. protection, leading some, like Japan, to fortify their financial and military positions.
And after this happened right around the time, maybe shortly after the U.S. debacle in Afghanistan, which was, the worst foreign policy, military disgrace, humiliation in U.S. history that I can remember. I don't know how far you'd have to go back to find a worse turn of events. And that there it was. Well, all of a sudden, allies all over the world, Israel, Japan, Taiwan, they're questioning the United States. Like, hey, we're under your nuclear umbrella. You stand by us through thick or thin. Here you leave Americans behind enemy lines. So perhaps, now this is speculation, but perhaps Japan sees the threat to Taiwan, feels they may be in the sights of the Chinese, feels the United States may not be as reliable as one had thought, and says, well, we now have to step up a little bit financially, militarily, etc. And they're doing that. But that aside, that's a little geopolitical speculation, but that aside, the gold is real. They put it on the books. So the biggest buyers of gold in the world are the central banks. By the way, from 1970 to 2010, central banks were net sellers. Now, some bought and some sold, but on net, they were net sellers. We had Brown's bottom in 1999 when the UK sold half their gold at the lowest price in about 60 years. they literally hit the bottom at about $200 an ounce, give or take. But since 2010, central banks in the aggregate have been net buyers, and that buying is accelerating. So what does that tell you? It tells you that the most knowledgeable players in the world are adding gold to their reserves because they consider that a prudent hedge to the US dollar, if you have US dollar inflation, or to collapse of confidence in central bank currencies generally, or they're just saying, hey, we're part of the club. By the way, here's a good trivia question for you, Shay. If you're in a bar and with a lot of brainy economists around, ask them, bet them a drink on this. Ask them what percentage of U.S. reserves are in gold. The answer in China is about 2%. Russia's about 20%. You know what the percentage is for the United States?
It's got to be 0.5%.
75%.
75%.
75%. The U.S. does not rely on euros and Aussie dollars and Canadian dollars for its reserve position. A little bit, but 75% of U.S. reserves are in gold. So don't let any central banker, don't let Jay Powell or Johnny Yellen or any of these others tell you that gold's not a monetary asset. We have the largest gold stash in the world. and 75% of our reserves are in gold. So that's the U.S., as they say, watch what they do, not what they say. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my. If you're Argentine and you borrow in dollars and you print pesos, how are you going to pay the dollars back unless you have, huge trade surpluses, which they don't. So they just default. Argentina is a serial defaulter and everyone expects that. If you borrow in dollars and you print dollars, which the United States does, they're like, what's the problem? Just print the dollars and pay the money back. Well, that's true. If you print dollars, there's no reason to default on dollar debt because you actually can print the money and buy the bonds. But it doesn't mean nothing else bad happens. What about inflation or hyperinflation? What about a foreign exchange rate? The exchange rate can collapse. And these modern monetary theorists show very little understanding of the international aspects. They treat the US like a closed economy, which it's not. If it were a closed economy and we didn't have to worry about trade deficits, trade surpluses, capital flows, exchange rates, foreign credit, China owning $1 trillion of US Treasury securities, which they do. If you didn't have to worry about any of that, I think they'd probably still be wrong, but they'd have a better case. But you do. She says, well, we don't really need a bond market, US bond market. We only have a bond market as a favor to investors because it gives them a place to put their money. They say when inflation happens, raise taxes. By the way, they also say you don't need a tax system because if you can just print the money, why do you have to collect taxes? And their answer is, we collect taxes to redistribute income. Okay, well, at least they're honest. That's kind of a socialist model, but they're honest about it. If you ask the typical member of Congress to define modern monetary theory, they'll look at you funny. They've either never heard of it or they certainly don't know what it means, MMT, Acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior, let's go back to COVID, as we talked about the debt to GDP ratio. So Trump put through a $2 trillion COVID relief package. And that was when, the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check. And then at the end of December, at the very end of the Trump administration, they did another $1 trillion almost. And that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. What the Fed does is nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying, you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone, he did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They just handed them out. And then later that year, they did the $1 trillion infrastructure package. And then, just to top it off, what we get recently was the just under $1 trillion Green New Deal, or I call it the Green New Scam. And the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, $1 trillion for the Green New Scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling, and MMT says it doesn't matter. But it does matter, and it shows up the way I described earlier, which is it slows growth. You don't get growth. So best case for the U.S. is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the U.S. will be in fiscal distress. If we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with yield to maturity below what the Fed will give you for a phone call. All those things are happening. That's hard data, and it's a very, very troubling sign. Last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with with the strongest dollar in 20 years. Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? We're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41, actually it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning, but it had started. I mean, in some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, well, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. In that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was, 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. Third quarter was a lot stronger, 2.6%. But when you dissect that, what you see is that was almost 100% driven by net exports. When was the last time the United States had positive GDP driven by net exports? Probably 1959. I mean, that's typically a drag on growth, and we've been running trade deficits forever. That meant that people were still buying U.S. goods, but we were not buying as much from other people. That's indicative of a slowdown. Consumption was weak, private investment was weak, inventories were weak. Those are the real drivers of the economy, and they were all weak. So, okay, net exports, that's not sustainable. So I would look for a recession, a more severe recession, to begin in the fourth quarter. That's one, combined with Fed tightening, interest rate hikes, balance sheet reductions, et cetera. That's one whole vector, and I wouldn't put any weight on a low unemployment rate. It ignores labor force participation rate, which is awful. It's down around 62% versus 70% in the year 2000. But beyond that, unemployment is a lagging indicator. Unemployment goes up after a recession begins. Employers are very reluctant to lay off employees. You got to pay severance. It's expensive to recruit and hire them back and train them. So you pretty much wait until the recession has already started, and you can, all right, I got to lay some people off. So it's not a leading indicator, it's a lagging indicator. So the Fed is behind the curve. There's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So